Hello boys, this is a video to explain the adjustments of task 10.23 in your textbook. Once again, I'm not going to explain the post-adjustment trial balance, okay, but I'm going to run through what you need to do to get there. I recommend that first you copy and paste all of the information that is on the pre-adjustment trial balance to the post-adjustment trial balance. In other words, all of the names of the accounts and all of the amounts in open brackets next to the names of the accounts. And then after that, you run through the process that I'm going to run through in this video, which is recording the effects of the adjustments. And then right at the end, you can just close your brackets and you can transfer the values to the debit and the credit columns in the post-adjustment trial balance. Okay, but you can mark that on your own. The memos has been sent to you. It has been released on Google Classroom. All of that. I just want to go through the adjustments based on the T account method. Okay, so remember the first thing you need to do is you need to figure out who we are. Okay, so we are working for Nova Clothing. And this is the pre-adjustment trial balance for the year that ends 28 February 2006. Okay, so immediately you need to think that their financial year ran from the 1st of March 2005 up until the end of February 2006. And remember, the whole point is we want everything that happens in this space on our financial statements. Okay, so if something happened here but it's not recorded yet, then we have to add it in. Okay, and if it's something happens outside the financial statement, but we have already recorded it because we paid or we received the money in advance, then we have to take it out. Okay, that's what all of this comes down to. Let's read the first adjustment. The first adjustment says the owner took stock at cost, 4,500 Rand for personal use in February, but this has not been recorded. Now this is a normal GJ transaction, which I'm glad about because we said that we can test GJ transactions from module 6. Okay, and the two accounts will look like this. Okay, so the two accounts will be stock, which is an asset, plus on the debit, minus on the credit. And remember, whenever the owner takes anything for him or herself, it's drawings, which is owner's equity plus minus. Please remember that drawings is a balance sheet section account. Okay, so if you have to go and add drawings to your trial balance, in other words, if it's not on the pre-adjustment trial balance, you have to add it to the balance sheet section. Okay, the value that the owner took was 4,500 Rand. It will decrease our stock. Okay, remember, because we have less stock in the business, and it will increase drawings. I've got my credit and I've got my debit. Transaction says the stock count at the end of the financial year reflected that stock costing 13,900 Rand was missing. Okay, now this is a different way to ask trading stock deficit or trading stock surplus. Usually we give you the value that was counted and then you must go and compare it to the value that is in the pre-adjustment trial balance for stock. However, this time we actually already did that calculation for you, and we found that 13,900 Rand was missing. In other words, the difference, the deficit, has been given to you. Remember, with stock, if it goes missing, we call it a deficit, which is an expense for us because we have to carry that loss. And if it's magically more than we thought it should be, in the pre-adjustment trial balance, then we call it a trading stock surplus, which is an income account. Okay, but that very rarely happens. It's usually a trading stock deficit. Okay, so the two accounts will be stock, which is an asset, plus minus, and trading stock deficit, which is an expense, plus minus. They gave you the value of stock that went missing, 13,900. We have to decrease it from trading inventory, and it makes our expense bigger. So plus in the expense, minus in stock. Next up, it says the tenant has paid the rent of 6,000 Rand per month for 11 months. Okay, so they don't say a lot here. What you must then assume is that the tenants have rented the property for the full financial year. Okay, and the problem here is that the tenants only paid for 11 out of the 12 months, which means 1 month is missing. Okay, if something is missing, we have to add it in. In other words, if it needs to be in the current year, we plus. Okay, if it's for next year, which it's not in this case, we would have to minus. They gave you the value of rent, 6,000 Rand per month, so we just have to go and increase rent income by 6,000 Rand so that the financial statements reflect not 11 but 12 months of rent. Okay, so the one account is rent income, which is an income plus minus, and we already said we have to credit it or increase it with 6,000 Rand. The other account is accrued income. Remember, the word accrued is used whenever something still needs to be paid. Accrued income is an asset for us because we are owed the money. We have already done our part. Assets plus on the debit side, therefore we debit accrued income. We've got our credit and we've got our debit, plus in rent income, plus in accrued income. Next adjustment says interest on the fixed deposit has been received 3 months in advance, and they gave you the value. In other words, if we look at our finance, we have received rent income for 3 months after this financial period. Not rent, sorry. We have received interest on the fixed deposit for 3 months after this financial year. Because it's for the next year, we have to now decrease interest on fixed deposit. Okay. They didn't tell you whether interest on fixed deposit is capitalized or not capitalized. And remember, if they don't say anything, the default setting is that it is not capitalized. Not capitalized means that it is like any other income we have received in advance. It is not special. Okay. Therefore, your two accounts are interest on fixed deposit, which is an income account. Please remember that. Fixed deposit is an asset for us, so the interest that we earn on it is income. And the other account is the one that is used for income that we have received in advance. The short name of the account is deferred income. It is a liability for us because it's the opposite of accrued income. And another reason why it's a liability is because we already have the money in our account, but we haven't earned it yet. So we still need to do something. Okay, we are still liable to act. Plus, minus. They gave you the value. Okay, so you just work with the value that was given to you. We want to decrease interest on fixed deposit because the value is actually for next year. So we want to take it out on the minus side. and we want to increase our liability. Debit and credit. If interest on the fixed deposit was capitalized, okay, this question always pops up. What if it was capitalized? The only thing that will change is the name of this account. Okay, it will have the same effect, but if it was capitalized, then the credit would have been the fixed deposit itself, okay, which is an asset, and we would make it smaller because the money would have already been added, but it shouldn't have been added yet. It should only have been added next year. Okay, so this is only if it was capitalized, then it would still have the same effect. It's just the name of the account that changes. Next adjustment says the monthly insurance premium of 550 Rand has been paid 1 month in advance. Okay, so in other words, we have already paid for March 2006. The rule is if it's for next year, we want to take it out. In other words, insurance must be decreased with 1. The two accounts that we use is insurance, which is an expense, plus minus. We want to make insurance smaller on the credit side with the 550 because this is for next year, that we have paid 1 month for the next financial year. And then the other account, the contra account, is prepaid expenses. Okay, it makes so much sense because we have already paid for something that has not happened yet. It is an asset because next year we can just sit back and relax and enjoy our insurance. Okay, we don't owe anybody anything. Therefore, we debit the asset. Next adjustment says a physical company revealed cleaning materials on hand at the end of the financial year with a cost of 1,050. Now remember how this works. Whenever cleaning materials or consumables or stationery or something is left at the end of the year, it means we haven't used it in this year. At the moment, the full value of cleaning materials in your pre-adjustment trial balance, if you look here, is 8,800 Rand. This value includes the 1,050 that we haven't used. In other words, our expense is not really this big because the 1,050 that is left will be used next year. So it must be an expense for next year. And we follow this rule. If it's for next year, we want to take it out. So what we do is we convert it into an asset. We say it's an asset for the business. It puts the business in a better position because we still have it on hand at the end of the financial year. And remember, we use one asset account for any expense that we have on hand, and it's called consumable stores. So my two accounts is cleaning materials because that is what we've counted. Cleaning materials is an expense, and the asset account is called consumable stores on hand, which is an asset. Okay, all we do is we change the identity of the 1,050 Rand of things that we've counted. We move it from an expense, take it out on the credit side, to an asset, put it in on the debit side. Up, it says an employee was underpaid for February in error. The difference of 2,500 Rand will be settled in March. The employee earned the money here in the current financial year. He worked for us in February. We should have paid him that 2,500 Rand in February, but we haven't paid it yet. Okay, so it is for the current year. It's just not recorded yet. Therefore, we have to go and add it. Please don't overthink things. They didn't tell you if this is a salary worker or a wage worker. But if you go and look at your pre-adjustment trial balance, you will see the company throws salaries and wages into one account. Okay, so don't let something as small as that stress you out. The two accounts that will be used is salaries and wages, which is an expense, and accrued expenses. Why? Because it happened. The word accrued means it happened, but it wasn't paid yet. Accrued expenses for us is a liability because now we owe someone money that we need to pay in the next financial year. We want to make salaries and wages bigger because we underpaid. So we need to pay him an extra $2,500. And our liability will then be the credit. Sorry, I hope you are sharp. I swapped my signs around. Liabilities is a plus on the credit. Okay, and that makes sense because our liability gets bigger. We owe more money. We've got repairs to the vehicle have been incorrectly debited to sundry expenses. This is just a normal correction of error. And correction of errors is so easy when it comes to adjustment. You minus it in the account where it shouldn't be, which is sundry expenses, and you add it to the account where it should be. Okay, if you look on your list of accounts, you will see that there is no repairs account in the pre-adjustment trial balance, but we've got vehicle expenses. So work with what we've got. We want to take it out of sundry and just move it up to vehicle. Therefore, the two accounts are sundry expenses, which is an expense, and vehicle expenses, which is also an expense. You minus the 2,700 in the account where it shouldn't be in sundry expenses, and you add it to the account where you want it. Okay, so minus in sundry, plus in vehicle expenses. Lastly, we've got our two depreciation adjustments. Vehicles must be depreciated by 25% on the diminishing balance method. Please remember this is the method where we use the cost price of vehicles, the 220, minus the accumulated depreciation of 90,000. Okay, diminishing balance method, it's a long name, so it's a longer calculation. It's cost minus accumulated depreciation, then you multiply it by. Will thus be cost, which is 220,000, minus accumulated, which was 90,000, multiplied by the percentage, gives you 32,500. Okay, please ensure that you type it in brackets in your calculator. The two accounts is depreciation, which is an expense. We debit the expense. And accumulated depreciation on vehicles, which is a negative asset, credit accumulated depreciation. 1 too many zeros. 32,500. The last transaction, pretty straightforward. Equipment must be depreciated by 10% on the straight line method. Straight line, straightforward, easy. You just take the cost of equipment and you multiply it by the percentage. So for this one, your calculation would have been the cost price of equipment, which was 207,000 Rand, multiplied by the depreciation rate of 10%. That gives you 20,700. Same two accounts, depreciation, it's an expense that is debited, and accumulated depreciation on equipment is a negative asset that gets credited. And that's it.